EBITDA, earnings before interest, taxes, depreciation, and amortization. That's what EBITDA is. You might have heard it before. What does that really mean? It gets thrown around a lot. That is your unencumbered free cash flow to cover your debt service. What does that mean? That doesn't get thrown around as much, but that's effectively the technical terminology to explain where you fit a payment. Earnings before. So we are adding these expenses and deductions back. Earnings before interest, taxes, depreciation, and amortization. That is the acronym that is thrown around constantly in all conversations, especially investment banking. But in commercial finance, commercial banking, got a surprise for you, and this is part of the mystery of the industry. It's not what they use. They usually use earnings before interest, depreciation, and sometimes officer compensation. Yep. Because the ordinary business income is your tax net income. They're not looking to add back your tax line item. They're not. They're just absolutely not. And the amortization, which is on, which you don't need to know, is a statement of amortization, depreciation, amortization, the 4562, that's on your tax return. If you file 1120, 1120S, or a 1065, they're not going down to that. They're looking on the first page. Do you have depreciation or not? They're not looking at amortization. Almost no institutions nationwide. I've worked with hundreds and hundreds of banks and lenders. They're not looking at it. They don't even know where to look, unfortunately. Okay, so what are they really keenly focused on or keenly interested in? EBITDA in banking is earnings before interest, depreciation, and sometimes officer compensation. And the discretionary officer compensation, which is the officer compensation in excess of your personal obligations. I'm going to explain this one again. So if you pay yourself $100,000 a year and you have $50,000 per your personal credit report and annual expense, then you have $50,000 in owner's salary, officer compensation in excess of your personal obligations. That sometimes is what they're going to isolate for the add back. Some banks, they're going to add the whole thing back. It depends, okay? So understanding that, and it's before, so what is it? Before these deductions, before I paid out the interest and depreciation, what's my net income figure? That's what it means. And that's where they're fitting a payment and doing a debt service coverage, where they're trying to understand how many times that figure, that earnings before interest, depreciation, sometimes officer compensation, at what multiple does that number cover the debt service? Now, really, really important is, if you have existing liabilities, that's not your unencumbered number. So you have $100,000 in net with add backs, but you have $50,000 in annual debt payments. Well, then you have $50,000 in unencumbered free cash flow to cover a payment. So that's where the bank is going to see, that's your free cash flow. Very important. You are over leveraged when all of your cash flow is encumbered. So it's not unencumbered, meaning it's already used. You can't use it again. You're over leveraged. You've used up the leverage because you've utilized all of your free cash flow, or what otherwise be your free cash flow. So in these instances, we look to refinance and restructure debt. And they'll look, and some banks will look and consider the savings. Some banks want you to debt service in addition to what you're already paying, which of course makes absolutely no walking around sense, but that's banking, and unfortunately a recurring theme in banking. It doesn't always make walking around logical sense. And sometimes factors are stacked against you, but it's understanding all of these key factors and parameters which helps you become eligible and get in an approval position. So it's just the rules of the game, and you have to understand them, and then you can play by them and abide and put your best foot forward and utilize that best shot at a first impression. So earnings before interest, depreciation, and sometimes officer compensation. And you can ask the bank you're working with. Very fair question. Well, are you adding back my officer compensation? It's a fair question to add, to be asking, to pose. So again, EBITDA in investment banking and the rest of the world's EBITDA as an acronym is not the same in commercial finance, how they're determining what you can afford in terms of a loan payment. Earnings before interest, depreciation, officer compensation. That's why they're important on a P&L when maybe your accountant doesn't care because there's no tax liability, but you need to have it, because if you don't, you are showing the bank, institution, the lender, you have lesser repayment ability than you actually do. So we're not beefing something up artificially. In fact, you are being less accurate by not itemizing these appropriately, which underrepresents your ability to afford debt, which can be cause for decline. So know and be empowered by this, and before you apply, understand these principles.